Hi guys, welcome back to the YouTube channel. In this video we're going to be talking about whether you should actually buy the property itself, or if the property is in a limited company, should you just buy a limited company? As tax advisors, JSM Tax, we get asked this question quite a lot of the time, because obviously from a stamp duty perspective, the difference that you could be paying is absolutely phenomenal. You've got top stamp duty rates up to 15-17% in some cases, whereas if you buy the shares in the company, you don't actually pay stamp duty land tax. Instead, well, you actually pay a stamp duty reserve tax, which is a lot less, typically 0.5% on anything over £1,000. So the saving for a typical property, it could easily be a very significant sum. If you're buying a property for $500,000, there's a massive saving there. But you do need to look at quite a few different factors, because when you buy the property, they're very, very different to actually buying the company itself. So when you buy a company, you'll take on any liabilities it's got, any other assets. So it's important to do the due diligence side of things, because looking back, whatever that company's done wrong, if a company's previously underpaid its taxes, that's going to impact you now effectively, because if HMRC come along, you're now the company owner, you're the director and shareholder. As a result, you'll have to pay up and fix that. But the most important thing is actually the cost of the property itself, because you might agree to buy a property, say the property is £500,000, you might agree to buy the company for £500,000, but actually that would put you in a worse off position, because from a tax point of view, when that company then sells the property later on, it's actually not that £500,000 that you paid for the company that gets taken into account for tax purposes. It's actually what that company originally bought that property for. That could have been 10, 20, 30 years ago, and could be way less than the £500,000 that you've technically paid for it. So that's one thing that you'd have to factor in and make sure you negotiate with the vendor, so you actually get that reflected into the share price that you purchased the shares for. Because if you just buy the property outright, yeah, you'll pay some stamp duty now, but you know that you've not got any historic liabilities, and you've actually, from a tax point of view, that property stands you at £500,000. So if you sell it a couple of years down the line, it's that £500,000 that's going to get taken into account from a tax point of view. That's kind of a very simple overview of it, but if you can do it, and you can do it right, if you are doing a large property purchase, if you're happy to do the due diligence, as long as you get a good discount for actually the tax side of things. So if you look at what the tax liability would be, you get at least that discounted off the share price, then it can actually be a fantastic way of doing things. But of course, just make sure you've got good people on your side, a solicitor who's done this before, the tax advisor who's done this before, so they can look through the books and see what any potential tax liabilities there might be. If you find this video useful, please do smash that subscribe button and give it a like. Until next time, guys.